What if I told you that for gold to match past historical levels, it would need to explode to $26,000 or even $75,000 per ounce? Sounds crazy, right? But here's the shocking part. This idea isn't coming from hype or speculation. It's coming from real data tied to one of the biggest financial risks in the world today, U.S. debt. Right now, gold reserves cover only about 3% of U.S. federal debt, which is one of the lowest levels ever recorded. Compare that to 1980, when gold backed around 18% of the debt. That's 6 times higher than today. And if we go even further back to the 1940s, gold was backing over 50% of U.S. debt. That's a massive difference. So naturally, people look at this and start thinking, if gold were to return to those historical levels, its price would need to rise dramatically. Around 400% increase would take gold close to $26,000 per ounce, and an even bigger jump, nearly 1,400%, could push it towards $75,000. These numbers grab attention instantly. They sound like life-changing opportunities. But here's where things get interesting. Just because something can be calculated doesn't mean it's realistic. And this is where most people misunderstand the situation. Welcome to Gold_Scope, where we break down complex financial topics into simple, clear insights so you can actually understand what's happening behind the headlines. Now think about this for a second. If a country had zero gold reserves, like Canada has had in recent years, then its gold-to-debt ratio would be zero. So if you try to calculate how much gold would need to rise to match historical levels, the answer would be infinity. Literally impossible. This simple example shows us something very important. These extreme price targets like $26,000 or $75,000 are not predictions. They are just mathematical comparisons. They highlight how big the debt problem has become, not where gold is guaranteed to go. And that's the real story here. The reason gold looks so low in comparison is not because gold is weak. It's because debt has exploded at an unbelievable pace. The system has created more and more debt, faster than gold or even the economy can keep up. So instead of asking, will gold hit $75,000? A smarter question is, what does this massive debt actually mean for gold going forward? Because that's where the real opportunity and the real risk lies. Now let's take a closer look at the real problem. And this is where things start to get serious. When we talk about U.S. debt, it's not just the total number that matters. What really matters is how fast that debt is growing compared to the economy. This is measured using something called the debt-to-GDP ratio. In simple terms, it tells us how big the debt is compared to the country's total economic output. And right now, that ratio is going in the wrong direction. Over time, both debt and the economy naturally grow. That's normal. But the problem is that debt is growing much faster than the economy itself. And when that happens consistently, it creates an unsustainable situation. We saw a major spike during the COVID period where debt surged sharply. After that, there was a small pullback, but here's the key point. We never returned to previous levels. Before COVID, the debt-to-GDP ratio was around 102 to 103%. After COVID, it stayed elevated at around 115%. That means the system didn't reset. It just moved to a higher level of debt and kept going. And here's what makes it even more concerning. This trend isn't temporary. It doesn't matter whether the economy is growing or slowing down, whether it's peacetime or crisis. The debt keeps increasing in every scenario. Now let's talk about the second piece of the puzzle, the annual budget deficit. The deficit is basically the difference between what the government spends and what it earns. And most of the time, that number is negative, meaning the government is spending more than it earns every single year. During recessions, the deficit becomes even larger because governments spend more to support the economy. But what's worrying is that even during normal times, the deficit is still growing. Over the last couple of decades, the pattern has become very clear. The highs and lows of the deficit are getting more extreme. It's becoming more volatile, and on average, it's trending downward, which means bigger and bigger deficits over time. This tells us something important. This is not just a temporary issue. It's a systemic problem built into the way the financial system works. It's not about politics. It doesn't matter which party is in power. The structure itself encourages more borrowing, more spending, and more debt creation. So now the big question is, what can actually be done about it? If you were in charge, you'd only have a limited set of options. And in reality, it's not going to be just one solution. It will likely be a combination of several approaches. The first option is something called financial repression. This is already happening in many ways. It involves keeping interest rates relatively low and allowing inflation to slowly reduce the real value of debt over time. This approach is popular because it's less visible. Most people don't immediately notice it. Inflation becomes a kind of hidden tax, slowly reducing purchasing power. At the same time, lower interest rates can support markets, boost borrowing, and make things feel stable, at least on the surface. And here's the key connection. This environment is generally very supportive for gold. The second option is fiscal tightening, which basically means the government becomes more disciplined. This could include raising taxes, cutting spending, or reforming major programs. But this option has a big problem. It's politically difficult. Anytime you raise taxes or cut benefits, someone feels the impact directly, and that makes it unpopular. So while this option might happen to some extent, it's often delayed or only partially implemented. The third option is real economic growth. Strong, meaningful growth driven by innovation, productivity, and new technologies like AI or energy advancements. In theory, this is the best solution. If the economy grows faster than the debt, the problem can gradually fix itself. But in reality, this is very hard to achieve at the scale required. Yes, economies grow over time, but as we've already seen, debt is still growing faster than that growth. So to truly fix the problem, we would need an extended period of unusually strong and sustained growth, much higher than historical averages. And there's another complication. If governments try to increase taxes while also encouraging growth, those two goals can conflict. Higher taxes can reduce incentives for innovation and productivity. So even the best solutions are not easy to implement together. So after looking at all these options, here's the big picture. The system is under pressure, and there is no easy way out. We talked about financial repression, fiscal tightening, and economic growth. But there are still two more paths that governments often take when things become more difficult. The fourth option is monetary intervention. This includes things like money printing, also known as quantitative easing, or controlling interest rates through policies like yield curve control. Even when central banks say they are tightening policy, history shows that eventually they are forced to reverse course. When the system starts to slow down or break under pressure, they step in again, injecting liquidity, supporting markets, and effectively increasing the money supply. Sometimes they even rebrand these policies to make them sound different, but the core idea remains the same: more money in the system. And this is very important because more money supply generally leads to currency weakness over time, which directly supports higher gold prices. Now, the fifth option is something nobody wants: a disorderly outcome. This could be anything from a major financial crisis to a global conflict, a sudden inflation spike, or an unexpected external shock like a pandemic or cyber attack. When a system becomes fragile due to high debt, even a small crisis can create very large consequences. We've already seen how quickly things can change during global events. And when debt levels are this high, the system has less flexibility to absorb shocks. In these types of scenarios, investors typically rush towards safety. And historically, gold has been one of the strongest safe haven assets. So when you step back and look at all five paths together, something very interesting becomes clear. No matter which combination of these options plays out, whether it's low interest rates, more money printing, slow growth, higher inflation, or even crisis situations, gold tends to benefit in most cases. The only scenario where gold might struggle is a very rare one. That would require governments to suddenly become extremely disciplined, drastically reduce spending, increase taxes without hurting growth, and at the same time achieve strong, non-inflationary economic expansion for many years. In theory, it sounds possible, but in reality, history tells us this kind of perfect balance almost never happens. And that's why many long-term investors continue to pay close attention to gold. But here's the most important takeaway. This doesn't mean gold is guaranteed to hit $26,000 or $75,000. Those numbers are just extreme comparisons based on past ratios. What really matters is the direction of the system, and right now, that direction is creating strong long-term support for gold. If you want to stay ahead of these trends and truly understand what's happening in the world of gold and silver, Make sure you stay connected with gold silver underscore scope.